On June 17, 2026, the Federal Reserve held interest rates exactly where they were. Nothing moved. Yet, the Dow Jones plummeted over 500 points, and the 2-year Treasury yield spiked to a 1-year high. The market didn't collapse because of the interest rate. It collapsed because the new Federal Reserve Chairman, Kevin Warsh, ended the decade-long policy of transparency that defined the previous administration. On his very first day, Warsh cut the Fed's post-meeting statement down to a mere 130 words, the shortest in nearly 20 years. More importantly, he entirely deleted what Wall Street relies on most, forward guidance. He flatly refused to give any hints about when rates would move next. He then targeted the dot plot, the visual tool where Fed officials map out their future interest rate forecasts. Warsh was the only member who left his thought completely blank, openly suggesting the tool might be scrapped altogether. The shift inside the meeting was total. In March, 7 officials predicted rate cuts. By June, 9 officials were forecasting rate hikes. Their internal inflation forecast surged from 2.7% to 3.6% in a single quarter. For 15 years, the Fed handed Wall Street the test questions and answers in advance. That open book exam is officially over. Today, the market is flying blind, and every future Fed meeting is a potential ambush. The last time the Fed operated as a closed-box system was 1994, under Chairman Alan Greenspan. That year, Greenspan executed a series of sudden, unannounced rate hikes. The resulting shockwave caused a global bond market wipeout, erasing over $1 trillion in a matter of weeks. By stripping away forward guidance and minimizing statements, Kevin Warsh has intentionally dismantled the market's warning system. He now possesses the capacity to launch sudden rate hikes without a whisper of warning. Navigating a market where the central bank hides its hand requires different financial intelligence. That's exactly what we provide at Stewardship Finance Academy. Since you can no longer rely on the Fed to telegraph their next move, you have to adopt a strategy that protects your capital no matter what they do. While Chairman Warsh is publicly posturing about rate hikes, the Federal Reserve is quietly opening up a massive release valve for systemic liquidity right behind his back. After the 2008 crisis, regulators created a rule called the Supplementary Leverage Ratio, or SLR. Think of it as a strict credit limit that restricts how many assets large commercial banks are legally allowed to buy. In April 2026, regulators permanently lowered this requirement. This single rule change freed up massive reserves of capital, allowing commercial banks to immediately pump huge sums of money into U.S. government bonds. Analysts are calling this shadow QE. The money isn't coming directly from the Fed's balance sheet, but the effect is identical. They are tightening with their rhetoric, while actively easing with their regulations. This creates a stark divergence in the market. While retail investors are busy chasing high valuations in tech stocks, institutional smart money, like central banks and multi-generational family offices, are quietly moving their wealth in the exact opposite direction. They are heavily rotating into hard assets. In fact, global central banks are currently buying physical gold at a record-breaking pace, vacuuming up over 800 tons a year. The world's largest institutions aren't listening to the Fed's tough talk. They are following the hidden liquidity and anchoring their portfolios in tangible value. What we are witnessing aligns with a macroeconomic concept known as the supercycle. Historically, every 15 to 20 years, global capital rotates out of paper financial assets and shifts back into hard commodities. This chart tracks the ratio of the S&P 500 against the commodity index. Watch as the ratio collapses to a 50-year low. The last time this setup looked like this was the year 2000, right before commodities surged over 500% over the following decade. The supercycle provides the broad direction, but the immediate volatility is being driven by the fragile interim oil agreement recently signed between the United States and Iran. Donald Trump has already threatened to continue bombings if Iran steps out of line. If those negotiations break down, oil prices could easily rocket back past $100 a barrel, pouring absolute gasoline on the current inflation numbers. If you want a step-by-step guide on how to position your portfolio ahead of these macroeconomic shifts, check the description below and register for our free Stewardship Finance Academy Stock Investment Masterclass. With inflation hanging by a thread of geopolitical tension and hidden liquidity flooding the banking system, simply reacting to the daily news cycle will drain your accounts. To survive a closed book market, you need the 5-ring asset allocation framework the ultra-wealthy use to insulate their capital from central bank surprises. The core ring is gold. Driven by relentless, accelerating demand from central banks, It serves as your primary long-term defense against systemic shadow easing. The second ring is short-term debt. These instruments lock in risk-free, high yields that will actually increase if Chairman Warsh decides to launch a surprise rate hike. The third ring is commodities. Rather than just hedging against rising costs, directly holding the raw materials driving inflation allows you to profit from the structural supply shortages. The fourth ring consists of dividend stocks. When overvalued tech and growth sectors face steep corrections, these established companies provide a bedrock of stability and continuous quarterly cash flow. The final ring is cash. You do not hold cash for the yield. You hold it as pure liquid ammunition, so you can immediately buy discounted assets when the rest of the market panics. This 5-ring system functions as an integrated ecosystem, where the specific weakness of one asset class is neutralized by the strength of another. It makes Fed predictions irrelevant to your wealth. Stop trying to guess the answers to a closed book exam. Click the link in the description to join our masterclass and start building a bulletproof financial framework today.